share price of a firm and hypothesis. So the objective of this session is to discuss about dividend valuation, where we actually discuss irrelevance approach, which is hypothesis, and relevance approach, which is Gordon's model and Walter's model. So in this session, we will only discuss irrelevance approach, which is hypothesis. Gordon's model and Walter's model will be discussed as part of dividend decisions, which is a separate session. We'll also see distribution of profits or earnings as dividends to shareholders and alternatively retained earnings. So the distribution of profit or earnings can be made as dividends to shareholders, or alternatively it could be retained within the firm so that the firm can invest in acceptable opportunities going forward. So which approach is taken decides how exactly the dividend valuation method progresses. So we'll discuss a little bit about that. So first, during this session, what we do is to make sure we discuss valuation of dividends and explain two approaches as was told, which is dividend valuation, where the first one is irrelevance approach, the other one is relevance approach. So to start, we have to know what is dividends and what is the alternative of dividends. So dividends, as you must understand, is that portion of net earnings of the firm which are paid to shareholders on the basis of shares of the firm that are held by these shareholders. Alternatively, instead of the profit being distributed as dividends to shareholders, the earnings or profit of the firm can be plowed back in the form of retention of earnings or as retained earnings so that they could be used for investment requirements of the firm. Hence, broadly, we have situations whereby larger the retained earnings, smaller will be dividends, and also larger the dividends, smaller will be the retained earnings. So elaborating, we see that a major decision of the financial management is dividend decision, whereby the financial experts choose between whether to distribute the profit as dividends or retain them as retained earnings to be used later for firm's investment purposes. However, there are conflicting views or approaches in the case of dividend decisions. According to one school of thought, the impact of dividends on the valuation of a firm is irrelevant. That's why we have this irrelevant approach, which is what gets convincingly laid out by Miller-Modigliani hypothesis. And the other school of thought says there is a significant impact of dividends on the valuation of firm, which is promulgated by Walter's model and Gordon's model. So we'll illustrate this and explain how each of these approaches are relevant in any discussion on dividend valuation. So we'll see the general premises of dividends and retained earnings. So here in this section, broadly what we do is we will see what is dividend decision and financing decision. We will see when do we retain earnings. We will also see when do we distribute dividends. Now we will come across return on investment, which is R, and cost of capital, K. If R is greater than K, that is, if the returns are greater than cost of capital, a firm invests in acceptable opportunities through retained earnings. If there is a shortage of funds in retained earnings, firm raises the shortage by equity or debt. If retained earnings are more than funds to finance investment opportunities, the remaining fund is distributed to the shareholders as dividends. So that is the general premises of dividends. We'll see in detail what exactly this means. So those who support the irrelevance approach of dividend to valuation believes that dividend policy of the firm is part of financing decision. Remaining its part, the dividend policy is residual decision and dividends are passive residual. Now to get into the details of this scenario, we will see the cases when a firm declares a dividend and when it does not. If dividend policy is financing decision, whether dividends are paid out of profits or profits retained will depend upon available investment opportunities. The hypothesis is when a firm has sufficient investment opportunities, it will retain earnings to finance the opportunities. If not, the earnings would be distributed to its shareholders. To illustrate this in theory, for adequate investment opportunity is dependent upon the relationship between return on investment R and cost of capital K. So this we have already explained. So long as K lags behind R, a firm has acceptable investment opportunities. In the sense, so long as a firm can earn a return that is more than cost of capital, it will retain earnings to finance available investment opportunities. If retained earnings falls short of funds required to finance the opportunities, it will raise funds in the form of external funds from both equity and debt to make up the shortfall. This is also explained. However, if the retained earnings exceed the fund requirements to finance acceptable opportunities, the excess fund is distributed as cash dividends to its shareholders. With a lot of available and acceptable investment opportunities, the dividend payout ratio would be 0. When there exists no opportunities, the dividend payout ratio will be 100. In other words, so long as a firm is able to earn more than the equity capitalization ratio, the investor would be satisfied with the firm retaining its earnings. In contrast, if return is less than equity capitalization ratio, investor would prefer receiving dividends. Now in this session we will go through in brief the irrelevance approach, which is Miller-Modigliani. The relevance approach is dealt with in a different session on dividend decision. So first we'll take a look at the irrelevance approach, which is hypothesis. According to hypothesis, what matters is investment policy of a firm. So what do you mean by that? So what one means by that? hypothesis provides the most comprehensive argument in support of irrelevance of dividends on the valuation of a firm. So according to hypothesis, what matters is the investment policy through which a firm increases its earnings, and as a result of which a firm increases the value of a firm. So in other words, given the investment decision of a firm, the dividend decision splitting the earnings or profit of a firm into packages of retained earnings and dividends does not matter as far as valuation of a firm go. Hence, in effect, hypothesis states that under conditions of perfect capital market, rational investor, inexistence of tax discrimination between dividend income and capital appreciation, given the firm's investment policy, its dividend policy has no influence on the share's market price. This has also been made very clear by the hypothesis because it has an equation here, NP0, which is equal to n plus delta n into P1 minus I plus E divided by 1 plus KE, where total capitalized value of a firm is the number of shares times price of each share, which is P0. So NP0 is basically that product of which is actually the total capitalized value of a firm, where N is the number of shares outstanding at the beginning of the period, delta N is the number of new shares issued at the end of year 1 at price P1, I being the total amount of capital budget, E the earnings of the firm during the period, and KE the cost of equity capital. So here in this equation there is no need to memorize it. Only thing or the only point we have to take is that there is no mention of dividend. So there is no mention of dividend, which is D or delta D. There is no mention of that. So we can say that dividend policy has no effect on the share price. So that basically covers the irrelevance approach. So the hypothesis basically says that there is no presence of ND1 or minus ND1 or D1 or D So in this equation, so basically ND1 cancels, and it is concluded that dividends D1 does not exist. Since it is not found in the equation, it implies that dividends do not count and the dividend policy has no effect on the share price. So this completes a session on dividend valuation. Basically also covers hypothesis and the irrelevance approach we have taken so far. The relevance approach will be dealt in a different session under dividend decisions. Thanks.